How oil prices impact major currency pairs. When oil gets volatile, which currencies react first, and why do some of those moves never get confirmed in Forex? Some traders catch the move and profit, others don't even understand why the market suddenly freezes. In this video, we'll break down how oil feeds into FX market, which pairs tend to react first, and when a move in oil is real versus when it's just noise the rest of the market ignores. Why oil matters. Think of oil not as a regular commodity, but as an economical signal the market pays attention to. When it moves, it sends a message about the whole economy. It mainly hits three areas. Inflation, because higher energy costs work their way into almost everything. Central bank policy, because they may have to react if inflation stays high. Currency strength, because some countries benefit from higher oil prices and others get hurt. So the point isn't that the market is scared of oil itself. It's reacting to what those oil moves mean for inflation, rates, and different economies. Currency 1. Canadian dollar. The Canadian dollar is closely tied to oil, but here's the key. Oil alone isn't enough. If the US dollar is strong at the same time, oil by itself won't drive Canadian dollar higher. So what actually matters is the combination. Canadian dollar tends to move clearly only when oil is rising and the US dollar is weak. Currency 2. Japanese yen. Here the story flips. Japan is an energy importer, so higher oil prices puts pressure on its economy. But there's a twist. In times of market fear, the yen often acts as a safe haven. So for Japanese yen, oil isn't the only factor. Overall market risk sentiment matters just as much. US dollar and Europe oil doesn't move the dollar on its own. It moves inflation and rate expectation, and that's what moves the dollar. Here's how that plays out. If oil prices rise, markets expect inflation to remain elevated, which can support the US dollar. That's where pairs like Euro versus US dollar and Great British Pound versus US dollar react indirectly. So the key idea is, oil doesn't directly move FX, it changes expectations and the market reacts to that. Quick checklist. When oil starts moving, check this. Is the US dollar strengthening or weakening? Is Canadian dollar moving in line with oil? Is the yen under risk pressure or acting as a safe haven? Is the market pricing in inflation or ignoring it? Here's a simple way to look at it. If oil is moving but the rest of the market isn't reacting, you can't really trust that move. Conclusion. When oil moves, it's really asking the market one question. Is inflation about to change, or is this just a short-term shock? If Canadian dollar, Japanese yen, and the US dollar all react together, that's when you know the move is real. Now it's your turn. When oil gets volatile, what do you check first? The US dollar, the Canadian dollar, or do you go straight to gold?